We're good to go.
Thank you very much.
You're welcome.
I will call to order this Valentine's Day meeting of the Lawrence County Retirement Board. Would all please rise for the pledge of allegiance, followed by a brief moment of silence. I pledge allegiance to the flag
of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all.
Now please remain standing for a brief moment of silence. Thank you. Vanessa, please call the roll.
Controller Trustenheim,
Here.
Treasurer Rapone,
Present.
Commissioner Steelvogel. Here. Commissioner Vogler.
Here.
Commissioner Boyd.
Here. Public comments. Anybody from the public wishing to make a comment? Okay, I'm seeing none, mercifully. Minutes from our last meeting, which was November 15th, 2022, and I'll give my colleagues a minute to check those over, and then I'll take a motion to approve those or make any changes as necessary and expedient.
I will move that they be accepted.
Second.
We have a motion to Steelvogel, second Rapone. Any further discussion?
Just a quick question. I'm noting that at the bottom under public comment on the second page, Ms. Wilson noted that she would not be available for May and that we did decide on June 6th. And I just need to confirm, is that still, to everybody's knowledge, is that still the case? That would be the, this is February, March, April. This would be the next meeting of this
Yes.
board.
Yes.
Okay, so June 6th.
Yeah, that's what we had advertised in the paper.
Okay, great. I just didn't write it in yet, but, so I can write it in.
Yes.
Okay, thank you.
Absolutely. I'll note that there will be a new member of this board at that point. That'll miss you all very, very much. And certainly miss you, Sarah. It's been a pleasure professionally serving with you and working with you to manage the county pension fund. I submitted my resignation today for March. So just want to note that. But on that note, we have a motion and a second. Any additional discussion, questions on this? Hearing none. Question on the motion, all in favor, please signify by saying aye. Aye. All opposed, same sign. Motion carries. And with that, I will turn it over to our investment consultant, Sarah Wilson, who I believe will turn it over to these fine gentlemen for the meat of the meeting.
Good morning, nice to see everybody. So what we tend to do is we like to once in a while bring in Pennsylvania County firms, Pennsylvania state firms. And we try and look for a fit once in a while, and I think it's as an education piece, just to kind of, broaden. I know that you have seen Jeff and Vince at a lot of the conferences. And when we can, we try and make a Pennsylvania firm possibly within the pension funds. So this is as an education piece, and we turn it over to them. And then down the road, we can discuss it. And then what I'll do is I'll give you the market update from last year and a little bit of good news from this year. We know the market's been up a little bit. So I'm going to turn this over to Jeff and Vince, and then I'll jump back in.
All right.
Thank you. Great. Thank you. Thank you so much. If you don't mind, because it's a chore up and down, I'm going to be comfortable right here.
You're perfectly fine.
As I was saying, I've had some issues with falls and knee replacements and everything, but neither here nor there. Happy Valentine's Day.
Yes.
What you see in me is exactly what you get. So I will say thank you, thank you, thank you to the board. I will thank Sarah again for inviting us in. The opportunity all the time is great. I lecture at all the conferences all the time that probably you should look at the firms that support the conferences and the people and the different things that you do during the course of the year, and you're proving that. And it is well appreciated. So my background's simple. I worked 40 years for a union. I retired and was going to work for Jeff for a year or two, help him establish more clientele. That was 14 years ago. I kind of don't know how to, there's no exit strategy. So I don't know, but I consider
an exit, let's be honest.
it could be a lot worse because Jeff is not only an excellent boss, a brilliant man, and a good friend. So I'm going to stop rambling on and turn it over to him to go through the presentation. Thank you, thank you, thank you.
Thank you, Vince, and thank the board, and thanks Sarah for having us here. I do teach executive education at Wharton, but I will try not to be too professorial, but just a little bit of education, especially given the volatility of the markets that we're seeing. So just about Twin a little bit. There's a book here. We won't go through every page, but just on page 2, you could see that we are based in Washington County in McMurray, Pennsylvania, is our office. We've been there since 1994. We've been in business since 1990, so we celebrated 32 years together. We've worked together for a very, very long time. There's 2 father-son teams in Twin. Vince and his son were the first one, and then my son about 5 years ago joined Twin as well. So there are a couple of father-son teams. We are a local firm, and we do manage money for 11 Pennsylvania municipalities and counties. We manage, for example, if I just go up and down south, we manage money for Clarion County, we manage money for Washington County, we manage money for Cumberland County, for York County, we manage money for the city of Pittsburgh, for Allegheny County, for the city of Bethlehem, the city of Gainesville down in Florida. So public funds are really the bulk of our business, followed by Taft-Hartley's. Obviously, once we brought that guy on, we had 1 Taft-Hartley, and now you could see that we have 10 Taft-Hartley clients. So Vince has been very, very, very successful. What we do is we specialize in something called enhanced indexing. So what we worry a lot about focusing on managing risk. And that's really, really important, especially in highly volatile times. And even though we're only about $1 billion of assets under management and advisement, we're the 10th largest enhanced index manager in the country, according to Pension Investment. So we really specialize in the idea of taking a portfolio relative to the market, not taking a lot of risk, or taking the portfolio and lowering the equity market risk and giving you an equity market return, but with less risk. So we're always focused on risk. The product line on page 3, the strategy we're really here to talk about, and the strategy we manage for several counties, including Clarion County and Washington County and York and Cumberland, is our Dividend Select strategy. The third one down on page 3, it's a reduced volatility strategy focused on giving you market-like returns in the long term with a smoother ride, easier way to make your arc, easier way to make your smooth pattern of returns, but still giving you an equity return. On page 4, you can see we've been in business since 1990. Of course, now 32 years later, the team on page 5 is really very proud to say that we always tease. Steve Lawrence was the first person I ever hired right out of school. We hired him out of Duquesne University. He came to work for Twin. We helped support him get his MBA at night at Carnegie Mellon. And he got promoted several times. And back in 2008, when Vince was retiring, we always teased, we said, when we figured the apple didn't fall far from the tree. But Vince always points out, well, that was from his mother's side. So Vince always points it out. But we've been very, very pleased to be a team that's worked together for a very long time. That's also something unique about Twin. So on page 6, you see the investment team, which is myself and Steve Lawrence, Pat Roscoe, who's been with us since '97, and Sam, who joined us in 2018. And on page 7, a lot of firms talk about the fact that they care about providing compliance and doing look-throughs and providing transparency for the clients. But Twin really, really practices it in the sense that our last 2 SEC exams, we received 0 deficiency letter. The last 2 exams, the last one we received would have been in 2021, in April 2021. So we really do care about managing and doing a good job keeping compliance. So the process on page 8, just an overview. When I did my dissertation, it was in the early 80s. It was on dividend policy and its effect on stock returns. And I'll tell you that while the world has changed a lot since then, there wasn't CNBC back then, there wasn't an internet back then, there wasn't Reg FD back then. In other words, firms could tell their certain clients, well, here's the earnings announcement, well before the earnings announcement came. So while all the world has changed, it's still the case that if you want to beat the market, you have to focus on the tried and true. You still want to buy stocks that are cheaper than their peers, that have good earnings growth and good quality measured in a number of dimensions. But that's just the return side. What we focus on at Twin is the risk side, the right side of page 4. So page 8. So when you're looking at the right side, we care about what the risk is of the market, the beta, which is how volatile are you relative to the market. We care about the sectors. If we want to give you a portfolio that's going to be market-like, but either focus on beating the market consistently or giving you less risk and giving you the market return over time. And so the way we do it is we kind of have a bottom up and a top down. So we think about stocks as they're valued. Are they cheap? Do they have good earnings growth, good quality? But we also care about the gestalt, the macroeconomic environment. What about interest rates? What about the environment? How is that going to affect? Is the economy going into recession? Will value stocks do better than growth stocks? Will the economy become more volatile? And will less volatile stocks do better than more volatile stocks? So those are the kinds of things we're looking at. That's what we call a fundamental tilt. So in words on page 10, what we're trying to buy are stocks with good earnings that are cheaper, with good earnings surprise, good metrics, good quality metrics. The way we think about the market themes is on page 11, where we're thinking about, do we want the portfolio to be focused on dynamic stocks or defensive stocks? More variable, less variable, more volatile, less volatile, more value, more growth. Those are kinds of the themes, but whatever we do, it's all going to be at the margin. Because in the end, we're going to give you a portfolio that's going to look and feel and smell like the market, but it's not going to be the market. And we're going to try and again, in this case, give you market return with less risk. So how do we do that? And why is risk important? So page 12, I apologize. Now I'm going to be just a little bit professorial. The reality is that you were talking, Morgan, about budgets. And the thing about budgets is that one side always equals the other, right?
Well, that's the hope.
Right, that's the hope. Well, in the end, that's the
That's the
goal.
hope.
In investments, it's not the case. Because if you make 10%, that's great. But if you lose 10% and you make 10% after that, you're not back at even yet. You need 11%. If you lose 20%, 20% is not going to get you back to your starting point. You need a 25% return. If you lose 50, you're a pension fund, you have to spend 5%. 50 means you need 100. That extra 5 on top of the 50, because you're spending it, you're making benefit payments, that extra 5 costs you not 5, not 10, not 15, it costs you 22. The more you lose, the more you have to get back. That's unfortunately the reality of risk. It's asymmetric. We live in an asymmetric world. The cost of losing is a lot more valuable than the cost of winning. So think about that. How much can you get away from losses every year? The answer is no. Because on page 13, that goes back 125 years. It's the Dow Jones Industrial Average. Goes back to 1897, 125 years of data. If you ask the question, in 125 years, how many calendar years has the Dow Jones never declined in a calendar year on a monthly basis? How many times? Answer 2. That's it. 123 years, it declines. The red dots are showing you the declines. The average of those red dots, it's 12.2%. So in order to get the 8% return in the market, which is the average of the green bars, in order to get 8%, which is a good long-term return, in order to get that, you have to suffer through, on average, a 12% decline every year. That's the reality of investing. And the more you lose, the more you have to make back. So here's a little example. On page 14 is a little example. These are made up numbers. These are 2 columns of returns, A and B. They both have the same average return. If I took the sum of column A and the sum of column B, and I took the average by divided by 20, because there's 20 observations, I'm going to get 8%. They both have an 8% return. Notice column B is more volatile. the column A. The numbers on B are bigger than A. Well, if I invested in A that has an average return of 8% and the standard deviation of 20, I invest in B has an average return of 8%, standard deviation of 10. What's the difference at the end of 20 years? The difference on page 15 is more than $1 million, more than you started with. Why? Because it's less risky with the same average return. Well, that makes you say, well, wait a minute, I could drive a wedge between that $1 million, right? What if I gave up some return on average, but had less risk? So what would it be to have a 7% average return? Take 1% less every year. 1% less than every year than A. You have a 7% average return, but yet you have $300,000 more than B with an 8% average return.
This is why we hire people to do this.
Right, no, but, well, that's why you hire Mark Cat.
Absolutely.
Sarah understands that, but that's the reality. That's why they're always looking to diversify your portfolio. They're looking to lower, because you can take a return, you can invest in something with lower average return, but if it lowers your risk enough, you're better off. You have more dollars at the end. And when you're having to pull out 5% every year, so for example, the strategy that we managed that we're going to present last year, instead of being down 18.1, was down 11.7. So you save 6.4%. That's a big savings when the market's down. That's worth a lot more to you than underperforming by 4% when the market's up 30. A lot more to you. So that's really what we focus on. So what we're focusing on in this strategy on page 16 is giving you the equity market return with a smoother ride. You're not going to get all the ups. You're not going to get the downs. But if you don't get the downs and you don't lose what the market is, and worse than that, you don't lose more than the market when it's down, you don't have to make up all that much on the upside. And so what we're focused on is how do we do that? Well, it's pretty easy, because what we're looking for are companies that have the smoothest earnings growth, right? The only way to be able to have a consistent price and not have your price all moving around is to have more consistent earnings growth. Well, how can you find companies with more consistent earnings growth? Oh, well, wait a minute. Some companies pay dividends. And if they pay dividends and they consistently grow their dividends year after year, well, then their earnings have to be growing. Otherwise, they're not able to continue to grow their dividends. So that's what we look for. We're looking for companies that consistently grow their dividends year after year. And so just to put it in perspective, on page 18, take the market, divide the S&P 500 into three groups. Look at the ones in red that don't pay dividends at all. Those are highly volatile stocks. These are 5-year earnings growth rates. Is it wonderful to have a 40% 5-year earnings growth rate? Yes. Is it terrible to have a minus 20% 5-year growth rate? Yes. You do not want to be invested in companies that have 5-year earnings growth rate that's minus 1%, much less minus 20%. So they're highly volatile. Now, do they pay really great returns at times? Yeah, when that red line is going up, they're paying off really well. What's the smoothest line here? The smoothest line is dark blue. Dark blue, those are companies that have always grown their earnings for the last 40 plus years. They've always grown their earnings between 5% a year and 15, maybe 17% a year. You're not going to get the plus 20s, you're not going to get the zeros. Those are the companies that we're focusing on and we're going to buy in this portfolio. So we're going to focus on the Dividend Select Club. On page 20, you say to yourself, okay, well, how did these stocks perform over that 40-year period? On page 20, you can see that the market is up 11.08. These stocks were up 11.6. But to be fair, that's because they're less risky. They are less risky on all periods, whether it's the long period, whether it's 1 year, 3 years, 5 years, 10 years, they're always less risky than the market. They don't win all the time. They don't win all the time. Market's up big, they're going to trail. But when the market's down, you're likely going to win. So let's look at that. So look at page 22 and look at page 22 first and then 23. So 22 says, okay, we understand the Dividend Select Club are companies that consistently grow their dividends. Then there's other stocks that pay dividends but aren't consistent growers. or they may not have the ability to pay, right? They may have high dividend yield, but their earnings may not be able to keep that dividend, they're gonna have to cut it. So we care not only do they have consistent growth, but do they have the ability to maintain that level? Are they earning enough today and projected to earn enough to make that dividend payment? And so there are other non-dividend paying stocks, and then there's those that don't pay dividends at all. And those are the Googles and the Amazons and the Facebooks of the world that don't pay any dividends. Apple pays a dividend, Apple's in the club. Now, it pays 10 years of dividends, it's now in the club. Microsoft has always been in the club. Johnson & Johnson's in the club, Procter & Gamble's in the club. Companies that actually can pass inflation on to their customers, they're in the club. Those are the companies that kind of make it. How do they do? So let's look at all months. Over all months, the market on average, you can see on average, the market is up 98 basis points. The Dividend Select Club, in fact, on average, notice the three groups give you the same average return. They do. They give you the same average return, but they behave very differently in the patterns of up and down months. The only ones that outperform in down months are the Dividend Select Club. So if you look, when the market takes the 90 worst month of the market ever, in that period, on average, the market's down 5.7%. 5.7. How much are these stocks down? They're only down 4.8. How much are the non-paying stocks down? They're down 7.4 on average. Let's even make it worse. Let's say what happens when the market's down 5% or more. Go to page 23. 5% or more, what happens? Well, what happens is when the market's down 5% or more, the average return is down 8, right? It's down more than the worst. But this saves $1.50, 1.5% on average. The others all lose. So in the down markets, and that's 8 out of 10 basically periods that's happening. 8 out of 10 months, these stocks are protecting you. And that's really what we're giving you. We're giving you that protection. So when you look at it last year on page 25, you could see, again, we were down 11.7, 7 to be exact. The market's down 18.1. We outperformed, but when the market was up 28.7, we were up 26 the year before. We cannot win all the time. If you go to page 26 and 27, you can get a flavor of the pattern of returns. And as you can see, we win, even though it was an up quarter, Dividend Select still won last year. Why? Because less volatile stocks were still in favor. Dividends were still in favor. Dividend growth was still in favor. So it doesn't mean that every up month you're going to lose and every down month you're going to win. But most of the down months you're going to win, most of them, and the worst ones you're going to really win. And so for the year, again, 11.7 versus 18.1. If you look at it to the right, when the market's up, 12.5, we're not beating it. But that's okay, because in the end, for your ARC, the 11.5 is not so bad for your ARC. It's beating your target rate of return, and you're protecting on the downside when the proverbial stuff hits the fan. So the upside downside captures on page 27. And if you see here, what we're doing is we're giving you the market-like return, but we're doing it by reducing the risk, by taking less return when the market's down. We're down less. You don't have to make up as much when it's up. And that's really, really key. The portfolio positioning on page 28, it's not like this is a deep value portfolio. It's a little bit value and a little bit defensive. If you look at the page 28 on the bottom left, you could see that it's roughly 50 value and 50 growth as compared to the market, which is 48 value and 50 growth, 52 growth. So we're basically a little bit value, we are a little bit defensive, but we are still represented in all sectors. Would we be overweighted to staples? Yes, you'd expect that. Those are companies that consistently grow their dividends. Might you not be overweighted to communication services like the Googles and Facebooks? Yeah, probably, or an Amazon doesn't pay dividend, but not a lot. Again, we keep it tight. The overall tracking error is 3.7%. So we're trying to be within plus or minus 4% of the market. And if on the year where it's down 18 and we can be up 6.4, we're very happy with that kind of risk return trade-off. So that's the strategy itself. I will tell you that we've been on a roller coaster, not to take away anything from anything, but we've been on the Kennywood roller coaster. We've had really five now reversals of double-digit returns. So if you go back January 3rd of last year, January 3rd to June 16th of last year, market is down, as we point out here, 24%. From June 17th to August 16th, market is up 17.4. From August 17th to September 30th, it's down 17%. And then basically from October 12th, the low, to now, it's up 15+%. So it's just been a roller coaster ride. There have been, unfortunately, where do we go from here? I will tell you that the market volatility doesn't go away. On page 31, we're showing you here, it's a pretty picture, a lot of colors. Those who are colorblind won't appreciate it, but you can still see the bars. The bar, where the bar ends up is how many days that year the market was up or down by more than 1%. Last year was the third highest amount since I was born in 58, not 57, but our data goes back to 57. So it was the third highest year of the most volatile days in the market, the most volatile days. 2002 and 2009 were the only years with more volatility. As you know, both of those years, the market was actually, the economy was in a recession. We're not in a recession. 2022 was all about the Fed, finally having to go from a zero interest rate period and changing it. That's what caused the volatility. It's what caused the worst bond market ever, and the worst stock and bond market.
That's why capital's frozen right now, and it's more difficult to attract investment here.
Exactly.
Every plan's on ice.
Everyone. Yeah, no, they're not lending, and they're not, liquidity is dried up amazingly. And the only demand is, on the government 2-year at 4.5%.
Inverted yield curve.
Within the yield curve, it's the only place to really get something of, I mean, the 10-year probably is right. Hopefully the 10-year is right. Hopefully over the next 10 years, Morgan, inflation will be at a, more like a 2.5%.
Yeah.
Back to normal. But for the next year or two, it's not. And the 2-year, that's a very appealing return. The good news is that inflation, and the good news is on page 33, inflation as it was announced this morning at 6.4 annual, 7th month of annual decline, or 7th month of declines. You've gone from 9.1, which you can see on, you went from 9.1 down to, this is looking at the change in inflation. So the change in inflation for the last 6 months has been negative. We've actually been declining inflation for the last couple of months. On a 6-month basis, inflation is actually declining. So it is decelerating. Now they're saying the last print today, the pace of the deceleration is slowing. So we'll see what happens. The market was kind of flat before we came in this morning. The 10-year was still around 3.7, and the 2-year was at 4.55, 4.54. So we think that's still the case. The inverted yield curve is for you on page 35 if you like to look at the yield curve and you like to look at interest rates, because it is amazing to think about. The way you read this, with apologies, is the 3-month is on the left, the 10-year is the second to the right, and so if you look at the 3-month 10-year, which is really what the Fed looks at, you could see the inversion we're talking about, because if you look at it 1 month ago in green, or as of last week in dark blue, you could see the yields are right at that 4.5% level for the 3-month T-bill. And that's a lot higher than the 10-year, which is around 3.6 at the time. So that's an inverted yield curve as compared to, it's amazing to think about, just a year ago, 3-month T-bills were still sitting at 40 basis. We're sitting at 4+% for that a year later. It's just amazing. So we think volatility remains. We do think that the idea of taking a portion of your equity portfolio, whether you do it with Twin or you do it with anyone, but just to say, hey, we've had the best run. The 3 years between 2019 and 2021 were the best 3 years for the market since 97 and 99. 2000, 2001, and 2 were all down years. I'm not saying we're going to be down again in 23 and 24, but we're going to have a lot of volatility. And trying to have a strategy that reduces your equity risk is, given that equity is your biggest piece of your portfolio, makes sense, certainly in this environment.
You think the R word is coming then?
The recession word, I
Yeah.
think that, yeah, so I actually chair two foundation committees here in Pittsburgh, the the Jewish Federation of Greater Pittsburgh, which is about $350 million foundation. Stuart Hoffman, the former chief economist, is on my committee there, as well as for the Healthcare Foundation, which is about $170 million. PNC is still calling for a recession, a mild
I
recession.
mean, the market clearly thinks there's gonna be one, but
The market clearly, I would tell you that the bond market clearly thinks there's gonna be one. Whether the stock market thinks there's gonna be one or not is a question. But the bond market is clearly saying recession, we can't get away from it. You're absolutely right, there's no doubt. The 3-month 10-year has predicted correctly every time, anywhere from 6 to 18 months ahead. And so the inversion occurred October 25th of last year, the day it inverted. So I think that, yes, a recession in the latter half of this year, a mild recession is most likely. I would say still I'd give it more than a 50% chance. More than a 50% chance. And I will tell you that as you know, the market rebounds prior to the recession rebounding, coming out. So we're not in one yet. And the market peaked a year ago, so it maybe peaked early, but I do think that one does.
and maybe, monetary policies held that off too, the interest rates.
They definitely held it off. That's correct. And
Give them through.
the labor force, and the pandemic, and the change in the labor force, and the way that labor works has also, I think, affected because if it weren't for for wages, the Fed would be saying a different picture. They wouldn't be saying higher for longer, but they're saying higher and longer. But at this point, they're not saying higher. Everyone agrees to the 5.25. There's no real. But the longer is because wages are not coming down. I mean, they're coming down, but not to the level that the Fed would like to see. And so I think that the labor force is really what they're looking at. And yes, and so if they're continuing to look at it, Morgan, that means they're going to continue to do things that make things difficult for it, which does suggest that they're not happy that unemployment's hitting its 50th year low.
Yeah, they have to crack that.
They really do have to crack, and that's a lagging indicator. So they recognize it's lagging, but the labor force participation rates, wages isn't coming down, which would come down first before unemployment goes up. So, yeah, so not to be pessimistic, but it's probably.
I appreciate your candor.
No, it's probably good though to be prepared for continued volatility. Bonds, less volatility, but stocks still have some volatility to get out of the system. So any other questions? Happy to take questions. We'd love to do this. So thank you. And if we have the opportunity, we're always happy to come back to it. So
I think you front loaded the important point here, which is just the math on the annual returns in terms of the annual, 8% annual, if you're able to capture, less of the downswings and not as much, but a decent amount of the upswings. I think the math adds itself up. So
Very, very interesting when I come on with, I told you my background or whatever, and I say to them, I need an elevator speech. So this, what he just explained to you, I explained to people as this product is not going to sit there and hit home runs. It's going to hit singles and doubles all the time. It's not going to have the home runs. Where he's going on for 3 hours, I can tell you that in one sentence and do it that way.
but it's a very interesting investment perspective. That's for sure. Any questions for members of the board?
Yeah, thank you.
thank you very much. Thank you.
Very well explained.
Thank you. I'm so
Thank you for
glad.
that.
That's
Absolutely.
Our pleasure. Thank you so much for having us.
Thank you.
And get out on the road. It's wonderful.
We're happy to
I'm so
have
happy.
him. We're happy to be his first excursion.
Yes.
Thank you.
You watch me get out of a chair, and that's why you understand when I'm sitting when you're pledging.
That was
Now,
so prominent.
Would anyone else need an extra book?
Thank you.
I
Thank
think
you.
we're
Thanks
good.
for
Where's the treasurer's conference this year? I believe it's in Harrisburg. Harrisburg. So where's the, is the controller going into
Don't get up.
Philly?
No, it's in Montgomery.
Yeah, that's, you said, they're gonna call me. Thank you. Good luck in whatever your next endeavor is.
Thank you, I appreciate it. I'm gonna go work for the governor for a little bit.
Are you?
So it'll be a fun experience, actually.
Oh, you can't find a nicer guy.
No, I really enjoy
Well, both of them out there.
Austin too, yeah.
Yeah, Austin, well, Austin.
Well, you work probably.
Yeah.
He's from
Yeah,
Washington.
well, one of the things
Yes.
that, I was in charge of, purse strings for the union.
Oh, well, there you go.
Okay,
We're running,
okay.
which we could then, which we can't now.
Yeah.
Okay.
You know,
Yeah.
giving them, checks.
Right.
Absolutely.
But thank you,
Thank you
dear.
so much.
Oh, I gotta give you a hug. Oh, my
I'm
gosh.
gonna go work.
Hey,
so good to see you.
DCD.
Oh, I know. I'm so
Next
glad
couple
that you are because I've been
Yes,
imagining.
sir.
I'm looking forward to it. It'll be nice to challenge. And I Harrisburg.
Also, but you'll see just a little bit.
Little bit easy.
And I'll make sure there's not a line for you. I'll take care of that line. Oh, my gosh. I'm glad
I'm
you're
probably
doing
gonna
it.
host something.
Yes, I am. I mean,
And then end up.
Yes,
Well, I don't think later about here.
they want you
I
to.
don't know why, I just don't.
Right, right.
I don't know why.
Do it.
But I'm going out next week, and so I'm gonna go scout out a lot of hotels there.
Oh,
Try to residents.
Isn't that something? You
I like
can't,
having
yes, you
seats.
can't walk and talk at the same time now. Definitely.
If you're gonna do it, do it.
Yes.
That's
It's
right.
not easy
That's
to
right.
live that way for,
Absolutely.
wait, so
Yes.
you have to move out there and everything?
Well, you take your time. No, I'm looking forward to
No,
seeing
no,
you.
no, 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 no. I mean, that, well, so they have the position specifically, it's special assistant to the Secretary for Economic Development. And so they have me to, I'll be managing all the regional offices and then a number of secretary assigned, special projects around the state. But, so I am anticipating a highly mobile position, but headquarters in the hub is still there. So
Well, if you can ever help, let us know. And economics is, it's what I got my PhD in, so let me know if we can help.
you're two above me. I got my bachelor's in it.
No, that's okay. That's, I'm a glutton for
Get an
punishment.
education.
PhD's in
See you later.
So good seeing you.
Get a letter down here.
Excellent explanation. Yes, very well done. For this mind, it
Depends on
is.
who runs.
I caught it.
If there's only.
Thank you. Yes.
Surely Solomon put her name in,
Yes.
that don't mean nothing. Morgan will kick her out.
Are we gonna take it? Did you
Thank
see?
We will get out
Uh-huh.
of your way, thank you.
Thank you both. Good to see you both.
One second. Yeah, let me see if my friend.
I'll take a 2-minute recess here. Get some water, some tea. But that was interesting. Very interesting. And I'll note too that we're still on live stream. Just in case anybody.
You gonna be in Harrisburg next month?
I am,
Good, we'll look for you.
good. And, I should get the dates down. If you've got anything on Sunday or Monday.
Monday, I think I do.
But if it's Sunday.
Yeah, good.
We just, I just, got hired by Snyder County last year.
Congratulations.
Good.
Thanks. Yeah.
Remember the commissioner out there?
Joe Cantz is one of them. Used to be, but he retired. His name just escaped me, but Joe's a good man.
Yes.
Joe and I are on the
Forward to working
CCAP board together. Dave, where's your conference this year?
In Montgomery County.
Okay, Valley Forge or that area?
Yeah, there's a.
Oh, it's another, yeah, and it's really strange. So every year we host a hospitality suite, just because we send tourists, we do stuff with the association. Well, last year, they didn't have one, and you had to like pay as you go.
Oh,
And so it was constantly, usually, we'll have food, it's not all about, we'll do a lot of stuff. Well, they wouldn't let us do it. And this year, it's the same thing.
Oh, is it really?
It's like nuts, so we're not doing that. Because, everybody kind of, they start complaining, well, why is it closed down? Well, Marquette. And it's like,
There's some farm out there or something that turned into a
like,
hotel.
and I don't think there's enough room for everybody either. I think we're gonna go through that. So a lot of times when we do the smaller venue, and that's happened at
it
CCAP.
has.
And so as soon as they announce a hotel,
Yeah,
we book it.
right.
And then we'll go back and rebook it and try and get, would rather have the bed in the hotel than say
I-
20%.
Yeah,
And not be there and then having to drive back and forth,
Right.
you know,
absolutely.
yeah, this one's gonna be an interesting one. And we haven't gotten anything about it yet.
They gave us the dates, but it's about all that.
I'm gonna miss the one up in Erie. I like Bayfront.
Really?
Yeah, Erie, I think it's a fun town. I go up there occasionally. We can do, there's DCD offs up there.
It's hard to do like everything on a Sunday night, because they kind of close down on Sunday nights.
There's a restaurant there's a hotel right across from Bayfront. It's in walking distance. On the top of it though is a restaurant. I forget what it's called.
Oh, I'll have to remind me because somebody can do that.
It's a cool spot. It overlooks the bay and everything. It's beautiful. We've been there. Actually, our last time I was there, we went to one of the Warren exhibitions.
Alright,
There was
sorry about that.
escaping Warren, just like I was escaping Newcastle.
Okay, sorry about that.
No, you're good.
Okay.
Was that what you still out there?
Yes, I had to go say hi.
Oh, I gotta say that.
I said I had to go say hi to the Elwood contingent.
We're still live.
They were in the planning office from Elwood City. They're talking to Amy about their facade program, yeah. So,
Are we waiting? I guess we're waiting.
oh, there he is.
He took off.
Oh, okay.
I
Jeez.
missed him. That's all right. I'm seeing him Friday morning.
Yeah.
All right, we will reconvene the meeting unless anyone else has,
No, that was a
Waters
great
are-
presentation, yes, very good.
Good. So we'll just jump in and I know you've got a lot to do and everything, we'll just talk at exhibit one. I just want to give you a quick Marquette update. One of the things that I thought was really interesting that happened last year was we actually really, we always talk about giving back into the company and growing it. We hired over 40 employees last year. We have really looked at the infrastructure at Marquette and have put in, that has been IT. We've hired somebody who does all the research for a lot of our foundation clients, want to make sure that, you're investing in certain companies that meet their criteria, that, they're not in an oil company or whatever. So we've got a huge research department doing that now for there. And we've just really expanded. The Westchester office now has 14 employees, research, client analysts, performance analysts. So that's been a very interesting thing to see, especially during last year when we look at the market. And the other two real quick things, Kwaku, great guy who's out of Chicago. He just got appointed by President Biden to the Pension Benefit Corporation Advisory Committee. So that was
That's
a really,
awesome. Congratulations to him.
it was a really great guy. And the other thing I mentioned before is last week it was hired at Snyder County. So we've got now 14 counties, so that's nice. And we're looking forward to working with them.
And on board the 15th, right?
We're keep going. Busy here. Let's just quickly talk a little bit. I know Jeff touched about the market. That's in tab 3. And we look at what happened. US real GDP grew by 2.94 in the fourth quarter. However, appears to overstate the strength of the economy at the end of 2022. So you can see that year over year. We know CPI is coming out today. As Jeff said, it hit an all-time high at 9.1. They're expecting it to be about 0.4 in January, which means that, some of what the Fed has done is starting to help. One of the things I think, though, is that we have to remember is that CPI excludes, food and gas. So when you look at that, we can sit there and say all these numbers, but when you talk about the American consumer, you think about that and where are you going to get hit? Food's up 10% since last year. That's a lot of money when you add what there's there. So food prices are up. Gas again has gone up 30%.
Don't throw those eggs away like I used to.
Yeah.
Tell you that right now.
See, I get the Hello Fresh. And somebody asked me today what do eggs cost. Well, I don't have any clue.
Yeah.
I get them all bundled together. And they told me, I was like, I don't know if that's normal or not. It's not even
No.
close to normal.
And we look at, the Fed had raised rates again. We knew that was kind of built into the market. The market had done that. And then when we look at what the Fed is saying, we're expecting another 2 hikes this year, probably 4.5 to 4.75, yes. And, because they see indicators a lot differently. And as, it takes time to catch up. And then we talk about the recession. You look at page 10 below, you look at the recessions, and then we look at the leading economic indicators index declined by 4.2 over the previous 6 months, largely due to weakness in manufacturing and housing indicators. And we know when mortgage rates go up, we're only just starting to see this housing market decline a little bit. And in certain areas, it's not. And I think it said, last year, Pittsburgh came out to be one of the most expensive places per income direct in the, for rentals. So you're seeing that, and as we know, your real estate, because it's diversified, you're not in that retail. And that has really done well last year. It's gone off a little bit this year, and we'll look at that. So we look at disposable income, and I think that's important too. That's page 11. Look at the decline. So we had a bump up. We know in 2020 when we had stimulus checks, and Americans were actually kind of saving. And the consumer doesn't really like to save as much. You can see that we went up from 2018 to 2020, then we've started to go down, and then we're hoping that it will start going up on real disposable income. But as we know, when inflation hits and it's so expensive, that's gonna be less. And we also look at what's happening with credit. We know the consumers now who had, credit cards are up to almost 30% APR on some of them. So you've got consumers going and doing 4 payments to pay for gas at the gas tank. So, that's gonna all come back and hit the economy. It may not be in all the indicators that, the Fed will look at or, the market will look at, but eventually you'll feel it. And you'll feel it as when you look at, people who live in the county and how they're affected towards that.
I'll add one more. Student loan repayments are going to start hitting again, probably in June or July. And that's going to drain a significant amount of capital out of the market that will otherwise go back into consumption.
Right. You look at page 12, and we'll look at that. China actually had a little bit of a better. We look at what happened in the 4th quarter with your international, your global managers. Remember last year, they said they closed cities down. They were really stringent on their COVID policy. They relaxed that a little bit. We look at projected rate hikes, and we look at that across the board, across Europe and everything. 2023, all the way till November, we're starting to look at there will be more projected rate hikes across globally. And then we look at, where the Fed's going. Problem is, they lowered them too fast, we believe, then they spiked them back up, and they're gonna find a pretty medium. Long gone are the days at 0%, that was almost a gift in some ways. When we look at household firms' rise in energy costs, one thing that was really, we still have the war going on in Ukraine, and, at one point they thought it wasn't gonna last as long as it did. The scare was, especially when you looked at Europe, was the rising energy costs, and they had a mild winter. So that actually kind of was very good for the market.
Even the weather affects the market.
It does, because it affects energy. I think Exxon was up 80% last year. That's incredible, when you look at what's happening. We look at the global asset class performance. Just touch briefly on this. You can see for the quarter, we were in international equities were up 17.3. Remember, I've always said is you do have exposure to emerging markets because they go down a lot faster, but then they pick up, and that's where you get a lot of your alpha. And that diversification you've done over the years has really benefited when we look at performance there. And as commodities were up 16.1%. Just want to turn the page. We look at the sector returns. I find this is really interesting. Consumer discretionary and consumer services, the loan sectors in the red due to negative returns from mega cap stocks, Alphabet and Amazon. And that is why you like a well-diversified equity portfolio. Remember in 2020 with COVID, 5 stocks took the entire market down for those 4 days, and then 5 brought it back up. You know, if you can pick those 5, great, we're not going to. But that really, when we had looked at the volatility, because in that quarter we were negative, and usually we do much better in a negative return. It's just, there was nowhere to go. Managers just didn't know, you know, you have only 5 out of 500 stocks driving the market. But we can look at that. We see energy was up 63.2, value stocks, top growth stocks during the quarter. And, you know, we have a little bit of a value tilt for 4 years. Growth at 16 quarters, growth was outperforming value. You just kind of have to stick with it. And when you look at a pension fund, you don't look at 1, 5, 7, 10. You're looking at 10 years, your annualized return moving forward. Are there any questions on the market? All right, jump in if you've got them. I really want to get to how you've done. All right, so we look at on Exhibit 3, page 22. The market value as of December 31st was $87.8 million. You had a gain of $4.8 million in the quarter, and you were right on your policy index. You did 5.8 net, meaning minus all the fees versus a policy index of 5.7. In January, you were up again 4.8%, and you're at 91.5 million. So you've seen some nice growth. We look at the year, and the year, I think this really says what we have done, what you have done is work in diversifying and, you know, doing the different asset classes. You were down 12%. The market was down 13.8. So you outperformed by 1 point, exactly what we wanted it to do. You know, great. It's the market on, you know, going down. The 7-year annual return of the annualized return for the fund is 7%. You've had a gain of 22.8 million. Right there, you've made your actuarial assumption. Going forward, it is going to be a lot harder to do that year by year. And you have prepared for that. You know, you're well funded. But last year was a tough year. And we know that. And we know that there's going to be some volatility in there. And we'll look at the managers and how they've done. Since inception, you've had a net investment gain of 42 million, returning 6.6% net versus policy index of 6.7. You had outperformance by your active equity managers, infrastructure manager. JP Morgan had a return of 7.7% last year, and their relative benchmark was 0. So they have done, so that's positive performance for the year. That's when we did infrastructure, we did real estate as well. And then underperformance by fixed income managers, it was slight. You know, we always like to say, you know, why was there a little bit of an underperformance? Fixed income, it's just so hard for the managers. You know, we watch and we make sure, but they were just off by a few basis points. Looking ahead, we'll probably have your actuary come in and do an actuarial review this year. I think that's going to be good.
I get to miss that.
I think that's good for planning, especially because your EC is going to be coming up. It's going to look different this year. Employee education, if we want to do that again, we haven't done it in a while. I know after this year, it might be something that we might want to look to do in the summer, or maybe, you know, towards the end of the summer. And let me know if you'd like me to coordinate that with Korn Ferry, because I think that's a nice thing to do. We haven't done it in a couple of years. We had COVID and everything, but I think we can get a lot of questions about your pension fund this year, you know, coming off of last year. So I think that's important. And the other thing is we did do a lot of addendums to update your investment policy statement. I think probably this year, towards the end of the year, we might briefly do a little bit of an education on your investment policy statement and just make sure it's updated. We're doing new ones for all of our accounting clients. It doesn't change your asset allocation. You don't need a vote on it. It's your document, but I always kind of like to update them every 1 to 2 years on that. Any questions so far? All right, so let's just go to, and I do have to say that last year you're on the top 25th percentile of Investor Metrics public database. So across, when they go look, it all define benefit from two are in the top 25%. So that is nice. Let's go to page 30 and we'll just quickly go through. So your total equity composite for the year was down 16. But the market was down 18.3, and you can see for the quarter it was 9.8 versus 9.3. You did have some outperformance by Eaton Vance. They were up 11.6 versus 7.4. This is your active manager in your U.S. domestic. You know, we really find that to try and beat a manager that's going to beat the S&P 500, we've done the Fidelity Index 2 basis points. To find a manager that can justify paying 40, 50 basis points in fees and outperform over time it's a hard spot. So we like this Eaton Vance, and you can see for the year they were down 8.8 versus 18.4. So they gave you some very nice protection in a down market. We look at global equity composite. You did 10% for the quarter, year 16 versus 18. We look at Dodge and Cox. Dodge and Cox, usually in the down market, they have some volatility. We like them long term. I mean, you've had them in for a year and a half, and they're dragging a little bit behind their benchmark. We are not concerned because they did what we wanted to do in the year. They were down 5.8 versus 7.5. We look at Artisan, they're outperform more, and MFS low volatility perform very well in an up market. So you can always have somebody that's going to do, you want a little bit of alpha, so you're going to want somebody who's going to outperform the market. Sometimes they won't do as well. So that's when we design these portfolios that we look at the end number. You look at non-US equity composite, international, just a little bit of a tough place to be, but you've done well. Harding Loevner, we put in January 2022. They did 13.5 versus 11.7. Wellington Emerging Markets did 11% for the quarter. And then obviously for the year, they were down 24. So remember, usually they go down much more, but then they'll go up in an up market. We like them. Real estate, you know, I have to say, you've made some very good decisions on when you have decided to diversify. And 1 year, 8.8% in a negative year. And remember, we funded that from fixed income. We also funded that from equity. So that is the part of this portfolio, is you just don't want to find a great equity manager, a great fixed income manager, a great global manager. What you want to do is make sure that you are diversified for going forward, because long gone are the days you can annualize 10% from the market and, you know, fixed income. You're just not going to see it. So that has done very well for you. And since that has been in March 2016, you've annualized 7.8% for that investment. We look at infrastructure. They did, JP Morgan did 3% for the month. Year, we put them in April, we funded them, they did 7.7%. We turn the page. We look at defensive equity. Defensive equity, remember, is only 5% of the portfolio. In this year, they for the month, they did 6.3 versus 4.3. They were down a little bit in the market. We still like them. They give you a little bit of nice performance, and you know, with the fixed income, they take very little risk. And then U.S. fixed income, I think this shows why that diversification made sense. Since we've been here, your fixed income has annualized 0.9%, not even a percent, since 2000, when we redid structure 2014. You've got Lord Abbott, we like them in the high yield. They just had a difficult year in fixed income. Now, C.S. McKee did 1.9. Remember, we decided that was your Pennsylvania firm. We came to you and said, let's put C.S. McKee in. They've done well. We like them a lot. And you can see the market was down 3.9. The market was down 4.5. They outperformed. They were only down 3.9. They are very good. They're low cost. They're great active. So we've now gone into active fixed income management. It was okay to use a mutual fund and to do an index, but now in this market environment, in the market environment going forward with fixed, we wanted to get an active manager in there. So I think that has paid off for you very well. And lastly, I think with all of this diversification, we're still in for 34 basis points. So very low cost fees. We've worked on lowering those over the years for you, with some good performance and with some very active managers within that. And remember, you're also in some funds that, your real estate, 80 basis points, you've got some of the active managers, but we were able to circle around that, with some indexes. And I also Seas McKee, 20 basis points, and that's because of Marquette stock, so much money they came in and did that for us with all of our clients. Are there any questions?
I'm gonna ask the question I ask every time, what percent are we at in terms of total funded?
Right now, I don't know, it was 105 or something.
I think you're probably, worst case after last year, but then you've also kind of bounced back in January. You're maybe 98 if we look at that.
We haven't gotten the new report for 2022 yet.
But last time we looked, we were 100 or
It
close
was
to.
over 100 last, 103, 105, something like that.
And then, you have last year's market, maybe a little bit down,
I
but
just want to make the point I always make. This is one hell of a secure fund.
yes, I would say.
Our employees are guaranteed their pensions and the taxpayers are protected from increased pension liabilities. They are not.
For now.
We have 4 years of back to back of last year. I might be looking for a new job. Oh, jeez. No, maybe. It's just, last year was a volatile year, and it's an interesting thing when you look at, take myself to look at younger consultants, going out there and having me explain being down on market. Done it. We've done, the .coms, we've done the 08s, and, so it is what it is, but it's long term.
Sure. Any public comments? Seeing none, Dan, good to see you. I'm glad you sat through that. Give another flair for county government. Any additional comments from members of the board? I will adjourn the Valentine's Day meeting of Lawrence County Retirement Board.
Thank you.
Thank you, Sarah. Good to see you, Sarah.
Great to see you all. See
Always.
you.
Yes.
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 Thank you so much, always.
You're welcome. It was great to see you.
Always good to see you, Sarah. Take care.
Thanks.
Yeah, take care, buddy. Bye. Good seeing you.